All right, 2024 market forecast. So this is going to have to do with supply and demand. And most prices, whether it is home prices or interest rate prices, always have to do a lot with supply and demand. And that's going to come into play this year in a real serious way. So when we're looking at overall what's going on with core inflation rates, which is a big driver of interest rates, which of course in turn drives how people behave in the market. We're at the core CPI number, which is the consumer price index that the Fed looks at, as well as the core PCE number, which is the personal consumption index. So when we look at these things, we have to remember that a core inflation has a lot to do with rents, meaning that shelter costs, which is rents, people that rent homes, etc., makes up 44% of the core CPI, and it makes up 21% of the PCE. Now, why is this so important? Well, when you're looking at this chart, you can see that rents, were skyrocketed. They were up about 14% from January of 2021 up until about June of 2022. Now they've been coming down dramatically. So year over year right now, we're hovering at just around 2.5%. So new rentals are right about 2.5% on average, more than they were a year ago. But that's great because as the year over year numbers keep coming down, that also means that they were going to be adjusted because the Fed looks at these numbers backwards. They don't look at it forwards. So they're averaging it out over the bigger inflation numbers and the bigger shelter cost increases from a year ago. So each month that the new number gets revised, it'll continue to come down. This is what we call the lag effect. So you can see here there's a lag effect of about 1.8%, meaning real time we're at 2.2% inflation rate on the core CPI and 2.3%. Now the reason why this 2% mark is so important is the Fed's target is 2%. 2% is their target on the core inflation rate, and we're getting really close to there. And when we look in real-time numbers versus the lag effect. So as the months continue to evolve and the new numbers keep coming out, those numbers are just going to continue to come down. Now in this slide, this just shows you that in December of 22 to a January length year in the 23, December of 23, 0.79%, 0.74%, and 0.76%. These are large numbers where they are going to be coming down significantly in those months, which will readjust how we move forward. Now, when we look at the rest of the year moving forward, we're not going to have huge changes probably in those inflation shelter cost rates because they started to come down already in the middle of last year. But here in the first quarter, we could see a significant decline, and we are anticipating seeing a significant decline in these numbers year over year, which is why the Fed is coming out and saying, hey, we're not even going to wait until we actually get to the 2% target. We might have to get in front of it and cut rates a little bit before then so that we don't put ourselves into like a serious jeopardy of a recession. If they wait too long and the lag catches up and then we're in a negative number, that would be very, very bad and would cause them to cut more dramatically and quickly. Now, expectations for inflation and Fed cuts. So Fed is expecting to cut interest rates this year multiple times. Their target is 2%, as I said, year over year. On the core PCE, it's currently at 3.16. Now, when we look at these charts moving forward, we're seeing that these are what the monthly estimates are. A 0.1% increase for December, which will be released later this month, 0.1% in January, February, 0.1%, so on and so forth throughout the year. So what this really means is that these first three, as I stated in the previous chart too, are going to make a huge impact because those are very, very low numbers that are going to replace, okay, the 0.39% number. So if we subtract, 0.1 from 0.39, that means that the core year over year PCE is going to drop to 2.87, which is fantastic. That's really, really great news. There is going to be a Fed meeting on January 31st, but we don't think that they're going to cut on the January 31st meeting. Now, moving forward, you can see that we're anticipating all these replacement costs. 2.47 is where we're estimating we're going to be for the January report that comes out in February. There's a March 20th Fed meeting. February report comes out a month later, and you can see that throughout the whole year we're estimating going down, and we're targeting that 2% level right around March. So 2% level right around March, April, and from April throughout the rest of the year, we are going to see these numbers just be a lot more favorable for the Fed to cut interest rates and make things a little bit more affordable within the economy. So this is all great news when we're looking forward, and it's very important to know this as a consumer or as a real estate expert agent, whether you're on the mortgage side or you're on the real estate actual side, so that you can communicate this with your clients and to not miss opportunities that they can do right now based on what's going to happen in the future. Because when the Fed does start cutting these rates and when they are to a target place of getting their balance sheet where they want it, which they've been cutting for quite some time, once those two things happen, a lot more buyers are going to be coming into the market. And with limited inventory, as I'll go over in a moment, we'll see that could cause another issue with home prices, meaning they are more than likely going to continue to go up as this develops over the next year or so. So with the upcoming Fed meetings, this is just like an odds maker. So these are like the odds of a Fed rate cut at all the different meetings. You can see March 20th, there's a 68% chance that they will start cutting interest rates formally on the March 20th. On the May 1st, 94% chance. And then moving forward, all the odds makers say 100% chance as we get into the second half in the year of the Fed reducing interest rates at every single meeting. So there's a 91% chance of a 50 basis point rate drop, so that means a 0.5%, and a 53% chance of a 75% rate drop, so that means 0.75% lower than it is right now. So these are, once again, all good things to know. I thought this was really interesting when I saw this Fed dot plot. So basically there's 19 voting members for the Fed. Each dot represents one member. This is a real chart. They anonymously give their opinion on what they think is going to happen, where they sit right now as far as cuts from the Fed funds rate. So you can see in 2023, all 19 members said, they were like, no, we don't see any cuts in 2023 at all. And they didn't. They did not lower the Fed funds rate, interest rate whatsoever. Now, what's interesting is that there's two people that still remain on the Fed board that say they don't think there should be any cuts at all this year. There's only one person that says, yeah, there should be a cut, but just 25 basis points. Everybody else that's a voting member, so the high percentage, 16 out of 19, think that the cuts will be somewhere between 0.5% and 1.5% in basis points. Now, what's even more interesting than that, though, is if you look at 2025 moving forward, they're estimating that they are going to lower them dramatically again here in 2025 and more cuts in 2026. So this means that we're just at the beginning of this interest rate decline, which is great for the real estate market and affordability, but it's going to continue here for a couple of years moving forward. It looks like 24, 25, and 26 rates will continue to go down as these cuts happen. So why is this important? Well, something else that is important to note is the Fed balance sheet. It's something that never gets talked about, and the balance sheet is the treasuries that they hold as well as mortgage-backed securities, so Fannie Mae bonds. And during COVID era, their balance sheet went up to an all-time high of 8.5 trillion, right? And right now they've already sold off, right, about down to 7.1. So they've sold off $1.4 trillion of these securities, these debts that they were holding. And that also kept interest rates really high. The reason being is because they have to sell something at a loss to get it off their balance sheet. And the only way to do that is interest rates have to be higher so they can make up some of that loss from an investment standpoint. So why is it important that they stop tightening? Quantitative tightening. So there's quantitative easing, that's when they stimulate, and there's quantitative tightening, which is when they don't stimulate and they also go ahead and tighten and hold, sell off their balance sheet basically. So you can see here that from 2014 to 2018 there was a balance sheet of approximately 22.4% of whatever our GDP was is what they were holding on their balance sheet. Pre-COVID in March of 2020 they had 21.3% they were holding on their balance sheet. Now the peak balance sheet number was April 2022, after we've been through 2 years of the COVID, the stimulation, and they were all the way up to about 33%, right, of the balance sheet versus the GDP. They want to get that number back down below 25. And we're getting close to there. We're already down to 25.6. And as we continue to run off, you can see here, these are the projections of them selling off their balance sheet through this year. It looks like 24, we're going to break below 25 right around March. Is that a coincidence? Probably not, with the Fed meeting and the rate cut, etc. And then moving forward, they're going to stay within this 22 to 24% range. That is going to allow a lot more liquidity in the market. That's going to allow a lot more investors buying these mortgage-backed securities, and it's going to put us in a position where this will really help create the momentum that we need, not just from the Fed rate cuts, but also from just an asset liability standpoint. This will aid in lower interest rates for everyone moving forward here in 2024. Now, these ones down here that I put a box around, this is where we get into the real sweet spot. And once again, I don't think it's a coincidence that it coincides with the other inflation numbers. Here in June, July, August, September, October, that's where we're in that sweet spot below 24%, and that's exactly where we'll want to be. Now, if they overcook it, meaning they don't address this fast enough, and they do kind of stay a little bit tighter than everyone's anticipating, that will 100% put us into a recession. Now, when we do go into a recession, mortgage rates decline during recessions. So I'm saying that mortgage rates are going to decline regardless if we go into a recession or not. But if they do, like over tight, stay a little too tight, and they don't address the issue in advance, we are going to see mortgage rates drop even quicker once they make that determination that we are in a recession. So you can see that every single time we've had a recession, these green boxes, that mortgage rates have dropped every single time, all the way back from 1975 to current day. Now, the forecast from an interest rate standpoint on 30-year fixed rate mortgages is between mid fives to high sixes. We're already in the high sixes right now, so we're anticipating mid 5% range to 6%. It's pretty conservative. If we do get under 6% interest rate, though, before the end of the year, this could unlock a lot of move-up buyers, people that are in their homes right now that have that 2.875% rate or that 3.5% interest rate, that don't want to move and feel handicapped from an affordability issue because it just costs too much for them to sell their house and buy a new one, even if they want one. But once we get under 6% into the fives, that spread is going to narrow and allow a lot more people to afford a different house, sell their current one, and keep the momentum going with transaction counts going up. 10-year Treasury, we're aiming that to be between 3 and 4.4%. And when I put the note in here of return to a more normal spread, we're talking about like interest rates, 30-year fixed rates, like to 10-year Treasuries. And usually where the 10-year Treasury sits, so let's just say it's at 4%, usually a normal market is about a 2% higher than that is what fixed rate mortgage is going to be. So if the Treasury is at 4, interest rates will be around, a 6%. Over the last year or so, the swaps have been a lot larger. Like the amount of spread is larger, meaning like 3% over. So if something's at 4.4%, we were at like 7.5% on interest rates. Treasury 4.4, interest rate 7.5 up to 8%. That's not normal. So that's going to normalize as well, which once again is all aiding towards lower interest rates moving forward. Now, from a real estate forecast this year, we're looking at inventory remains extremely tight. You can see in 2023, it looks like we're going to have a little bit of inventory increase, but it's not going to be anything dramatic. So the market's still going to be very competitive and very tight, even with the added inventory. You can see that from 2019 to 2023, we haven't got back to these 2019 levels of a normal-ish inventory, and we've just been declining in inventory. So more people wanting to buy homes, less stuff available, supply and demand at work equals higher prices. That's why prices keep going up. This is a great slide because it shows how the completions and household formations are outpacing completions of actual properties being built for sale that are available. So the blue line is household formations, people getting married, people moving out of their home, people having kids, starting their own families. And this level is completely outpacing the number of homes that are available. That is always going to lead to, once again, tight supply and demand. There's not enough supply, and it's almost impossible to get caught up at this point because the demand of the household formations is so far ahead of actual homes that are being built for people to purchase and live in. Now, let's talk about like a something that's the elephant in the room. Everyone wants to talk about affordability, is a huge issue. It always has been, but it feels like it has been even more in the eye of the media, et cetera, in regards to monthly payments. So in 2021, if someone got a 2.875% interest rate on a $240,000 home, that's about $1,000 a month mortgage payment, principal and interest. Monthly income of $4,000 a month. Well, in 2024, like right now, that same property that was 240 is now 280 because it's gone up in value, appreciation, and the interest rate at 6.625% now means an $1,800 monthly payment, basically on the same exact home as 2021. So that's an $800 a month increase. What everyone's focusing on, though, that you can see in yellow, is 80% increase. Now, while that's true, this is why you can't think of it exactly like that, because the increase is really based on a percentage of income. So the $800 increase is 20% increase based on this person's income in this scenario. So you have to remember that even though it went up $800, and that's 80% comparing it to a payment, that's not how we qualify for purchasing homes. We qualify based on monthly income and affordability. So it's really a 20% increase. So it's 20% more costly to buy right now than if you bought the same exact place back in 2021. The good news is that incomes have also risen 15% since June of 2021. So we're really not that far off from an affordability issue. This is something that's really important to recognize. Now, we don't have to make the payments, of course. The client has to make the payments and they have to feel comfortable with it. But we just need to know that, yes, it's less affordable than it was a few years ago. It's not as bad as it nearly seems, though, from a percentage standpoint. Now, 2024 real estate forecast, nationwide appreciation is expected to go up between 4.5% to 5% this year, and transaction volume is going to look to be up about 15 to 20% from last year. So these are all good things to know, to share. If you have any questions about any of this stuff, please let me know. But it's not going to be like a crazy year where we're going to have tons and tons and tons of more inventory. We're going to have about 15 to 20% more transaction counts this year. So let's make sure that we're telling people great information, that they can make a great decision. And if you need anything at all, let me know. That's the forecast here for 2024. Have a great day. Take care.